Building your business, literally. In this week's Emily Now episode, I'm going to be talking about commercial mortgages, why your business would consider getting a commercial mortgage, how you can figure out whether or not your business would qualify for a commercial mortgage. I'll bring it all together by giving you an example of a manufacturing and distribution company that we were able to work with who used a commercial mortgage for their business, and it had some great results. As well, we're going to talk about the crisis being over for commercial financing, and if you didn't know that there was one, then that's probably a good thing. So stay tuned. My name's Dylan Gallagher, founder of mlenow.ca. I've been a finance guy for the past 18 years, helping people and businesses get the money that they need. I work with private investors and banks to fund good deals, and each week we put together this Emily Now episode with a focus on finance and in particular debt, so that you can learn more about what's involved in getting a mortgage or a loan. We help you navigate the issues of mortgages and loans so that you can make better decisions, because we believe that if you can make better decisions, that you'll have money for the future, you can invest in new opportunities, and who knows, maybe even be in a position to give back to the community around you. We would encourage you to visit mlenow.ca to see for yourself what's involved in getting a mortgage or a loan. It's a pretty innovative platform, and we're looking to disrupt a very old industry. Getting money is not exciting, it's not fun, and so in our own little way we're trying to change all of that and make it easier for you to do more. We would encourage you to connect with us on Twitter, Emily Now Canada, and you can like us on Facebook, find us on Google+, and subscribe to our YouTube channel, all of which gives you the opportunity to post information back to us, post questions, interact with us, see the information that we're making available to you so that you can do more. And with every episode, we usually answer a couple of questions, give you an example of a real business that was able to benefit by using a mortgage or a loan, and then kind of give you a recap on what's happening in the market. And so our first question for today is, why would our business consider getting a commercial mortgage? And in short, really because of two reasons, either because of cash flow and or future growth and investment opportunities. Many businesses spend a significant amount of capital on their space, and each month they make their lease payment, and as they make their lease payment, they help their landlord pay off the mortgage that maybe they have on the property, or if they don't have a mortgage, then they're a good investment stream or a good investment income for the landlord. And for the last several years, interest rates have been at all-time lows, which means that a mortgage payment each month could be less than a lease payment. And as you would know if you're a business owner or are involved in managing a business, that cash is king, or cash is very, very important. And ownership of a building, believe it or not, might be one way to increase the monthly cash that a business has. And we'll get into how they can do that specifically, but kind of as a side note, if a business is going to buy a property and they're making that decision because the monthly mortgage payment is less than the lease payment, then when they're looking at opportunities, they might end up buying a space that maybe they can help subsidize the cost of that building by leasing out a smaller portion to maybe another business. So there can be very, very good reasons for how a business can take advantage of commercial real estate, change their lease payment into a mortgage payment, and now that they own the building, they might even be able to lease out a portion of the building, which because market rents are pretty strong in most markets right now, that they could subsidize some of the cost of that building. And so from a cash flow perspective, it can make a lot of sense for a business to consider purchasing a building. The second reason for considering ownership of a building for your business would be the future growth and investment. For business owners, purchasing a building and leasing it back to the business can be a sound investment. Many business owners want to take money out of the business, but they don't necessarily want to leave a big cash flow gap for the operation of the business. And so by purchasing a business, or rather purchasing a building and leasing it back to the business, a business owner might be able to take cash flow out that way. And so here's an example of kind of how that makes sense. business owners typically don't take a salary or a fee from the business until maybe the end of the year, or throughout the year maybe they take a few chunks of cash out of the business. And what that ends up doing, of course, is a business has a normal cycle of cash flow. So they, as a business, you might provide a product or service to the marketplace. You know how long it takes for your customers to pay you. You know what your costs are in paying your staff and paying the government and paying all of the costs associated with running your business. And most businesses kind of get a bit of a rhythm going. And so when the business owner comes along and says, okay, well, this is my business and I started this business so that I could make money, when they then reach into the cash flow and pull some money out, that can cause problems for the business. So in the context of purchasing a building, because most businesses budget a line item for their space, rent or office or lease payment, what that means then is that instead of that payment going to some unassociated landlord, if a business owner ends up buying a property and leasing it back to the business, first of all, they can make the lease payment more reflective of the mortgage payment as opposed to market rent. So there's some cash flow savings for the business there. But more importantly, now the business owner on a very regular basis, in fact each month, can take cash flow out of the business without it really disrupting the cash flow of the business if they were to take out maybe a dividend or a management fee at sporadic times throughout the year. So cash flow is a big reason for considering a commercial property, but also investment and future growth can be as well. Don't forget that real estate goes up in value, and so if a business is committed to buying a building 10 or 15 years down the road, if they've paid off the mortgage, then they're now sitting on an asset that's worth quite a bit of money. They can sell it, they can leverage it again for times when they might need money. If their business slows down or the market slows down and they need cash to keep them going, they can always leverage the real estate to get that cash out. So if you're interested in seeing what would be required for your business to get approved for a commercial mortgage, you can get started at mlenow.ca. You simply punch in kind of the amount of money that you think your business would need to buy a commercial property, and then you can flow through the rest of the steps and see the paperwork required, see the basic math that the bank is going to want to prove, and kind of see the questions that you're going to be asked before you kind of get too far down the road. Our second question today is, how can our business afford a commercial mortgage? Obviously, very important question. Our general rule of thumb, or when we're looking at opportunities that come through mlenow.ca or someone has asked us for our help, we tend to take their monthly lease payment and we sort of say, look, have you been able to make your monthly lease payment for the last couple of years or the last 5 years or the last 10 years? And if a business says, yeah, we've been able to do that, and then we're able to look at their financial statements and see that they have some net income, usually our general rule of thumb says, if you've been making money and you've been making your lease payments, then the amount of your lease payment is probably the amount that you could be using to pay for a mortgage. And so you take that monthly lease payment and you can do some math or use mlenow.ca and you can figure out, okay, well, if this is how much money we're spending in a lease every month, what would it look like if we were to get a mortgage? It's important to keep in mind that your business also has to have the cash or equity available as a down payment for the purchase price. But it's important to note, and most businesses don't realize this, but many banks will offer competitive financing options for a healthy business that has a track record, has history, has cash flow, has some retained earnings, and many times they're not even going to require any upfront cash to be used for a purchase. And maybe they might do something like, look, we'll buy the entire property for you, but now you can pay for the improvements to the property. Or maybe they'll say, look, we'll give you a mortgage to help buy the property, and then because cash flow is pretty important to your business and we can see that, but because you put so much cash through the bank, tell you what we'll do. We'll give you a mortgage and maybe amortize it over 15 years, and that little bit you're going to need for a down payment or equity, we'll give you a 5-year term loan for that. So between the loan and the mortgage, if that's even required, it can still be more cost effective than signing a 5 or a 10-year lease on a property that at the end of that period of time, maybe you're not going to have anything left to show for it. I mean, you got to use the property, obviously got to make some profit, generate some revenue, service some customers. But if you took that same amount of time knowing that you were going to have that cash flow or that lease obligation, maybe you could have turned that into equity, and at the end of 10 or 15 years, you now own an asset instead of having just rented it or used it. And of course, it's always important to know what your return on cash is. This is always a big argument for business owners when they're considering commercial real estate. They say, look, Dylan, if I had a couple of $100,000, I get a better return just pumping it back into my business than I do tying it up in a piece of real estate. And that's true. But what if the real estate didn't cost you anything? What if you didn't have to put a couple of $100,000 into the real estate? Well, then that kind of changes everything, because if you didn't have to put any cash into the real estate, the bank was able to lend you that money, but they were able to do it at lower rates than what the mortgage payment compared to the lease payment. Mortgage payment is less. What if they were able to do that? Well, now you're kind of looking at a bit of a different decision. Commercial mortgages, it's important to know, are shorter than residential mortgages. So it's not typical that you would get a 25-year commercial mortgage, or that you'd probably even want one. You probably get a 15-year, maybe 20 years, but 15 years is probably what you should budget for. And so if you think about it, you didn't put any cash in, really low interest rates, within 15 years you've bought an asset, it could make sense for your business. I'm not saying that it always does, but it could make sense. You're also going to want to know, when you're trying to determine, how does our business know if we can afford to do this? Well, there's some additional costs that are involved in commercial real estate. There's appraisals, there's environmental reports, structural reports, mechanical reports. Basically, there's a bunch of due diligence that you have to do when you buy a commercial property, and there's costs associated with that due diligence. And so they're not huge costs, but they are costs that can run the tens of thousands of dollars, and so you would need to have at least that kind of money available to make a purchase. The first step to understanding how you can afford a commercial, if your business can afford a commercial mortgage, is actually to determine the why. Why is it that our business wants to buy this commercial property? Is it cash flow reasons, investment reasons, future growth reasons? We just need kind of more space and we want to know that we have it. So once you've done that, then the next step is to understand the math. How much are you leasing right now? What are your leasing costs? And if that was converted into a mortgage, what would that look like? And then obviously the last step is to visit mlenow.ca. Take the first two steps and now start to work through the process of putting the rest of the pieces together. At mlenow.ca, if you've never used it before, you can create an account, get a score for your business out of 10. It's really simple. And based on that score out of 10, you can then take a look into the lender marketplace. There's hundreds and hundreds of lenders in the Canadian market who we have scored for you as well. So you can take your Emily score, match it against the score of these banks and lenders, and really get a handle on what your options would be. So if that works for you, check it out at mlenow.ca. And hopefully this has given you a little bit of insight into how you can begin to think through, can our business, or how does our business afford a commercial mortgage? I'm going to talk about a manufacturer and a distribution company that built their own building for millions of dollars. They're a successful company. They're not old. They're not 20 years old, but they've got some life on them. They're a successful company that manufactures and distributes a product kind of all over the country. They've had tremendous growth in the past few years, and that's a good thing. They also acquired a company a year ago, and now that company has just shot to the moon, and so this company is not in hyper growth mode, but for what they do, it's pretty much hyper growth. And if you ask them, they would say it's hyper growth. But the building and the warehouse and kind of the facilities that they've been using and duct taping together just haven't been working for them. And so they spent a considerable amount of time in the market with commercial leasing agents trying to find a suitable building, and kind of here's what they came up against. Either the buildings that they could afford from a lease and committing to a 10-year window, because they needed to know that they had the runway to let their business continue to grow and expand. So the buildings that they were looking at either didn't have the function that they required, or they had the function, but now the lease terms were just too expensive and they couldn't seem to make the math work. And so what did they do? Well, they went into an industrial park in an area that they like, and they found just a piece of land. They found a couple of acres, and they constructed their own building. The cost of the land plus the cost of the building and a mortgage was more affordable compared to the straight leasing costs and commitment of a 10-year lease. But not only was the decision motivated by cash flow, but it was really also motivated by the needs of the business. By constructing their own building, they were able to build exactly what they needed for the next decade of growth. And so today the building is more than they require, but the cost savings and confidence of knowing and having the next decade of space available to them was worth the effort and the energy. And keeping in mind that just because they've built a building and maybe they're not using all of it, they can find other users for that space and actually subsidize the mortgage payment by doing that. I don't know if they're going to do that, but that certainly would be an option. So at first they considered doing a sale leaseback where maybe they didn't, they thought, well, as a business, do we really want to own a property? Let's just go find some investors who we can sell the land to. They can build the building for us, and then we'll just lease it from them. So we kind of get the leasing option. We don't have the ownership headaches, but we also now get to know that we've got our building secured for the next 10 years or however long we need it. And then the owners thought, you know what, maybe as owners, we will buy it and lease it back to the business. It'd be a good investment for us. We're very active in the business, and so we've got kind of a good sense of what's happening, and this could be, a good thing for us in 10 or 20 years that we've got a paid-for asset, we've got great cash flow coming off of it. But then ultimately they decided that the property was the best investment for the business. The owners just said, you know what, if this is, if these two companies, if this is kind of what we're doing and where we're going, it probably makes sense that we put this asset in the business. So they decided to do it that way. The owners are more than happy with the decision, and after spending years of trying to work around the problems that they've been having with their facilities, they can now focus on growing the business, on serving more customers. And as a side note, so this was a deal that was millions of dollars, and they didn't have to put in hardly any cash whatsoever. The bank understood their need for cash flow, got really excited about the position of both of these businesses, the history of both of these businesses, and offered them just an amazing financing solution that, normally if you were out door knocking as a business owner and tried to put this together, probably wouldn't happen. But we were able to work with them, and they ended up getting just a great deal put together. So if your business is considering a commercial mortgage, much like this business for some of the same reasons, go to mlenow.ca, create an account, get your Emily score, and see which banks or lenders will accept your request for financing. But more important than that, at mlenow.ca, it's not just a website and an online platform. There's a real team of people behind it that are helping structure deals and put deals together. So you can hit the live chat, you can call us, you can send us emails, but more importantly, if you go to mlenow.ca, you stick your request in, it's going to land on someone's desk, and they're going to be able to interact with you and actually help you put your deal together. Well, this is a topic near and dear to me, and it was motivated by an article written by JLL, which is an investment firm offering real estate services in Canada to investors and folks that own and manage property. They were talking about the crisis being over for commercial financing, that lending seems to be on an upswing based on the survey or the conversations that they've been having with lenders in the marketplace that they work with. Even insofar as saying that lenders not only expect to lend the same amount of money that they did last year, they actually hope to increase that. And so I thought it was important to say, well, kind of what does this mean for you as a business owner? And given that we've been talking about commercial mortgages and businesses buying commercial mortgages, it sort of seemed appropriate that this would be kind of a good item to discuss today. Just as a recap, in 2008, when the market bottomed out, probably, I think for me, all the way until mid 2011, even early 2012, the credit market just froze almost instantly. And in fact, I remember the month that it froze for lots of reasons, but money was impossible to get. Commercial mortgages virtually instantly stopped, and they also were kind of the last to come back around. In fact, it was easier to get a business loan, and it was easier to get a residential mortgage than it was a commercial mortgage over the years of kind of the bottom of the trough. Land was impossible to finance. It didn't matter how good your land was. It didn't matter how much money you were going to borrow against it, 10%, 20%, 30%. It didn't matter. No one was doing land. But over the last couple of years, things seem to have come back. And with the publishing of this article and these results, it sort of seems like it's official that this commercial financing crisis is over. Land is kind of more popular now. It's easier to get a land deal done today than it was even a year ago. Interest rates are low, lenders are active, and so in the context now of your business and what this means for you, if you're looking at purchasing a property and your business has been around for a few years, maybe your lease is about to expire, or you can kind of see that in the next couple of years it's going to expire and we want to plan for the future, that because of the mood of commercial lenders today might be the day to start putting a plan together for buying a building or purchasing an asset. The cost of capital is very low. If your business is growing or has plans for growth that will impact the building or the premises that you operate out of, you might want to take a moment to consider a commercial mortgage. In the past, from up and until 2012, when a business went to the bank and said, "Look, I'd like to borrow money to buy a building," the bank would say, "Great, well, let's look at your last 2 years of history." And those were the hardest 2 years of history for many businesses to show a bank. And so businesses really, it was tough to get approved. In 2014, now doing a 2-year look back, many businesses can actually show, okay, before the downturn, things were okay, and then we dipped. But then, in the last 2 years, you can definitely see financially that things are back on the upswing. That means that a lender will look at that information and say, okay, great, we would like to consider lending money to you. So if you were wondering, if maybe a couple of years ago you went to the bank as a business owner and they said, "Look, we're not interested in lending to you today," if you went back to them today with the same request, you'd probably find that they would be more open to listening, and they probably would be very interested in presenting you with a term sheet or a commitment letter for some different options. We, of course, can help you with that. So if you visit mlenow.ca, take in the commercial mortgage amount that you're looking for, drop it into the main page, and then as you go through the rest of the steps, you're going to be able to see what's required. You'll be able to get access to all the lenders in the marketplace. In fact, you can use our team to help you do that, or you can just pick off the lenders that you want to look at your request and send it direct to them, and you don't need to use our team at all. But in either case, at mlenow.ca, you can maybe take a second pass at trying to see what your business would qualify for today and how you can put a deal together. So thanks for watching this week's Emily Now episode. Hopefully you were able to get some insight into commercial mortgages, what they mean for your business, how you can qualify, an example of how another business did it, and there's some interesting things there to think about. But we look forward to seeing you on the next episode. Thanks for watching.